Hello everyone and welcome to the NinjaTrader Ecosystem webinar room. Before we get started, I would like to take a moment to test for picture and sound. So if you can hear my voice and see the projection in the room, please type a Y. Great, thank you everyone. It looks like I'm coming in loud and clear. My name is Juanita Archuleta and I work on the NinjaTrader Business Development team here in our Denver office. We have a very special presentation for you today with Adam and Eric of Indicator Warehouse. At this time, I am going to place a poll into the room, and the question is, are you currently using NinjaTrader? While you fill that out, I would like to mention it is important to understand that there are substantial risks in trading commodities futures contracts. You should carefully consider whether such trading is suitable for you and will depend on your specific circumstance and financial resources. It is possible to lose all funds deposited with your broker and could even incur losses beyond these amounts. Please inquire at the following link for a full copy of the CFTC full risk disclosure. Also, please remember that these training webinars are not a solicitation nor a recommendation, but simply educational in nature. This presentation is presented by NinjaTrader LLC, which is the technology company responsible for developing and supporting the NinjaTrader trading software. Brokerage-related questions should be directed to the NinjaTrader brokerage directly at 312-262-1289 or by emailing brokerage.sales@ninjatrader.com. I am going to go ahead and review our poll results today, and it looks like 24% of you are currently using our free license key, 35% of you are lifetime license holders, 9% of you are currently leasing a live key, and 31% of you are not yet using NinjaTrader. NinjaTrader is free for advanced charting, market analytics, automated strategy development, connecting to a live data provider, and simulated trading. We only charge for our product if and when you do decide to trade live through any of our supported brokerages. If you have not done so, I would invite you to download NinjaTrader using the following link. And if you are interested in purchasing NinjaTrader, you're also welcome to take a look at our purchasing options at the following link. Today, Adam and Eric will explain how to easily identify current market conditions and trade accordingly. Thank you again for your attendance, and without further ado, it is my pleasure to welcome to the NinjaTrader webinar room Adam and Eric of Indicator Warehouse. Go ahead and take it away, guys.
All right. Hello, everyone. This is Adam Halpern. I'm the president of Indicator Warehouse. For those of you that are current NinjaTrader users, hopefully you've heard of us. We're somewhat of a household name in the ecosystem. And for those of you that are not yet using NinjaTrader, well then, hopefully seeing some of the stuff that we have to offer today will show you why NinjaTrader has been our only platform of choice since we started over 8 years ago. So we've actually been in their vendor community almost since the beginning. I think back then there was about 10 of us. And since then we've continued to maintain a leadership position, mostly because we have a name in the industry for giving what I call old school service. And we've always approached the human side of it. We don't ever hide behind web form and email. If you want to speak to a human being, we're here to talk with you. So I'm going to give you a quick overview of Indicator Warehouse proper, who I am, how I got to be here, and then the majority of this presentation is going to be Erich Senft, and I'll be in the background answering any questions along the way. If I need to interrupt Eric while he's going, I'm happy to interject with the questions, although typically we tend to save them till the end. If for some reason we miss your question because they start flowing pretty fast, please don't be offended. I'll make sure that my contact information and Eric contacts information is readily available to you. We're happy to address any questions we can now or after the session. Excuse me. So real quick, name like Indicator Warehouse, you can guess how we got started. When we first launched, we were the Amazon.com for day trading tools, if you will. And since then, I think that model of having an indicator store has evolved and been copied by a fair number of people in the ecosystem, and I guess that's the highest form of flattery. But over time, what we learned from feedback from our clientele was that, yes, there was a large number of people who wanted to buy individual trading tools and put together systems on their own. Excuse me. But there was a large segment that wanted more of a methodology or a structured trading system wrapped around these trading tools. And so in 2012, we launched the diversified trading system. That's really our, put us on the roadmap, if you will, our flagship product. And I'm not going to go into that now, but you're more than welcome to ask me questions about it afterwards or learn about it on our site. And then in 2014, we came out with a follow-up system more for entry-level type traders called the Raptor trading system. So we're into bird metaphors here if you haven't picked up on that. And what I learned along the way was that individuals didn't just want to buy trading software. They didn't want to just buy the tools for trading. They wanted the Bob Vila, if you will, of the tools to come with them. In other words, it's one thing to buy the screwdriver. It's another thing to have someone teach you how to use it. And that was the impetus for me going back to Erich, who was one of my original teachers, and convincing him to come on board. Gosh, that's going on like 6 years now. And Erich's been our lead trainer and trade room moderator almost since day one. You'll see why in a minute. He's got a gift for teaching. And then really, as they say, the rest is history. And so what we wanted to focus on today was more about trading education than any particular sales pitch or any tools. So hopefully you'll get value at it at a level that's useful to you, whether you're using our system or anybody else's system. So with that, I'm going to hand it off to Erich and mute my mic. And as I said, I'll be in the background. I'm happy to answer questions. Thank you.
Well, thanks, Adam, for that very nice introduction. And welcome, everyone, to our presentation today. We're going to be talking about understanding trader behavior in fast and slow markets. And, it's one of these things that is so instrumental to your trading success, and yet so few people pay any attention to it or are even aware of it. So that's what we're going to be talking about today. And like Adam said, this is kind of a universal subject. So regardless of your trading style, regardless of your trading system, hopefully this is something that you will find useful. My name is Erich Senft. Just a little bit about me. I've been involved in the trading community since 1995. Yes, that's right. I started trading way back in the 1900s. I'm also a registered commodity trading advisor and a trading coach. And as Adam mentioned, I'm very much involved with Indicator Warehouse. And I'm also written for various publications, including Trader Kingdom, MoneyShow.com, Technical Analyst Magazine, among a few others. I guess this is just my way of saying you that I've been around for a while, and I may be starting to get the hang of this trading thing. Hopefully I can shed a little light on a couple of details for you. Okay, so what's the problem here? What's the problem that we're going to address? Well, in short, the problem is that all or most traders treat all trading days as the same. You start the trading day, you think today is no different than the day before, which is no different than the day before, which is no different than the day before. You're bringing this production line or job mentality to the trading arena, and it's not like that at all. In fact, most traders fail to realize that the market conditions change. They can change from one day to the next, or they can even change during the trading day. And if you're not aware of the current market condition, how are you going to trade properly? Right? If the market is trending and you're not trending, how are you going to trade properly? Or if the market's in a sideways scalp mode and you don't realize that, how can you trade to make money? Well, that's what we're going to talk about today. Part of the problem as well is that the very nature of the markets create confusion. We got this constant tug of war between the buyers and the sellers. For a while, it looks like the buyers are stronger, then it looks like the sellers are stronger. And at the end of it all, we have this mishmash of information, and it just creates a whole lot of confusion, and it adds to this overall problem. What are we going to do about it, though? Well, first off, I think we need to recognize that not all trading days are the same. Therefore, your job as a trader, one of your biggest jobs as a trader is to learn to recognize what the market condition is and then trade accordingly. Let me just repeat that. This is very important. Your job as a trader is to recognize what the current state of the market is and trade accordingly. I'm going to show you how you can do that, and I'm going to actually show you a tool that will help you do that as well. First, I think it's important to recognize that markets have a life cycle. You know, a lot of traders, again, are blissfully unaware that market conditions can change. And Richard Wyckoff was one of the first traders to put this down on paper. I don't know if he was actually the one who first recognized it, but he was certainly one of the first to address the issue that the market has different life cycles. And the market cycle will repeat in all time frames. So it doesn't matter whether you're looking at a monthly chart or a weekly chart, a daily chart, hourly chart, a 5-minute chart. These market cycles occur at all time levels. So once you recognize what part of the market cycle you're in, you can trade accordingly. So if you're in a part of the market cycle where the market is advancing, well, then you trade one way. If you're in a part of the market cycle where the market's moving sideways, chopping about, then you're going to trade another. And as I just mentioned before, part of it is the markets create confusion to hide their true intentions. A lot of you will have seen this chart before. It's if you've been around in the trading arena for any time at all, you've heard of Richard Wyckoff. You've probably seen this chart where he identified 4 main phases of the market life cycle. You have the accumulation phase, then you have the markup phase, then you have the distribution phase, and the markdown phase. The accumulation phase is when the market tends to be moving sideways. But take a look at that accumulation phase. You see how the market is trying to move down, even though we know in hindsight that its true intention was to move up? And look at the distribution phase. You see how the market is trying to move up, even though in hindsight we know that the market's true intention was to move down? This is what I mean about the markets creating confusion. So during the accumulation phase, the market's real underlying intention is to move higher, and yet the market still will try to move lower. During the distribution phase, the market will try to move higher, even though its true intent is to move lower. Just a little something to keep in the back of your mind. I'm going to make this really easy for you, though. There are only 2 market conditions that you need to pay attention to. The first is a trending market, or what we're going to refer to as a fast market, because the trending markets tend to move faster. The second market condition is a non-trending or ranging market, and this is going to be a slow market condition. The market will always be in one of these 2 phases. It will either always be in a trending phase, or it will be in a non-trending or sideways phase. So your first order of business when you look at a chart is you need to decide, is the market trending or is it non-trending? That's the first question you need to ask. All right, so what do you look for? What does a trending market look like? Well, in a trending market, we're going to have big bars. There's going to be a lot of big bars. There's going to be very little overlap between the bars. They're going to keep stepping higher or stepping lower. There's going to be very small wicks or tails on the bars if you're using a candlestick chart. Or another way of saying that is the market is going to close near the high in an advancing bar, or it's going to close near the low in a declining bar. If you are trading intraday, you're also going to get the feel of a breakout. The bars are going to be printing rather quickly. You're going to see the price action try to push the bars higher or lower. These things are all going to have some momentum to it. And it's just going to have that breakout kind of feel to it. Here's a screenshot of a trending market to characterize what I've just described. You can see here we've got some, this is a downtrending market obviously. We've got some very big bear bars. Those are the black ones. You can see we've got large bars, low closing prices with the exception of maybe 1 or 2 bars. Almost all the closes were near the low on those black bars. Very small tails on those bars. So if you look at a chart like this, and you see all these black bars and all these low closing prices and all these strong bars, you should be thinking momentum. You should be thinking, hey, we're in a downtrend. This is a trending market. It's heading lower. So how do you trade a fast market or a trending market? Well, the challenge is not so much picking the direction. Rather, the challenge is where do I get in? Because the market is fast, it's probably moving quickly. You're probably going to be struggling to find the right spot to enter your trade. Well, if you're watching a market that's developing quickly, if prices are moving fast, I give an example here of 3 or more big bars. You get the Japanese charting, I believe they call it a 3 soldiers, where you get 3 big white bars or 3 big black bars forming. That's a very strong trending signal. Just get in anywhere. Your objective is to get in because you're suspecting that the market is starting to trend. You don't want to be left behind, so just get in. It is important, however, to use a proper stop. A lot of traders drop the ball on this issue, and this is perhaps something we can discuss in a future webinar, but there is such a thing as a proper stop for a trade. What I see a lot of traders do is they will throw a stop just behind the last bar. They'll only give the market 1 bar to retreat against them, or they'll use some sort of monetary stop, maybe a $100 stop or $200 stop, whatever. Those kinds of stops are likely to get tagged. To use a proper stop, you really should keep your stop above the previous swing high or low, depending on whether you're buying or selling, of course. This is another reason for trying to spot a trending market early, because if the market starts moving too far, you're going to find yourself with a very, very large stop, and you're going to have to adjust your position size accordingly so you don't end up risking too much money. But if you use a proper stop, you'll be able to ride out any little intermediate swings as the market starts to get some momentum behind it and continue with its progression, with its trend. But I just wanted to point that out because it is an important concept, something a lot of traders overlook. Another way to get into a trending market, of course, is to wait for the pullback. This requires a lot more discipline, and sometimes you're going to find that you wait too long because the market will already have advanced too far, the pullback will be insignificant, and you essentially have to write off the trade because you're getting in too late. But waiting for a pullback is an ideal situation to get into a trade on, and I'm going to show you that. The key to trading pullbacks, however, is only to stay with the trend, because very often pullbacks will have very enticing counter-trend setups. You want to avoid those because if you're in a market that's making a trending move, if you're in a market that's breaking out, you're not going to get a big counter-trend move. So remember to stay with the trend side. And because it is a trending market and you're expecting the market to be moving fast, moving a little bit further, this is probably the kind of trade where it's a good idea to have a runner in play, or perhaps swing part of the position, take a profit on some and swing out the rest of it. Try to hold on for a bigger profit. Okay, here's that same chart. So we've got the first pink triangle that you see there, where we have the three big bars kind of heading lower, and at this point you might be saying to yourself, it looks like the market might be trying to break out of that trading range that preceded it. Well, if you waited for the pullback, you can see you got a nice little pullback. The market broke down to the downside, made another move lower. If you weren't convinced off the first 3 or 4 bars that printed, certainly those 8 bars that headed lower should be convincing you right now that, hey, this market's in the downtrend. I better look to short. And you can see you had a couple other opportunities there to get in on the short side and take advantage of yet another move lower into the close, actually, of the E-mini on this particular day. So that's what it's going to look like. This is how you're going to trade a fast-moving, trending market. Let's take a look at the opposite of that, which would be a non-trending or a slow market. What does a slow market look like? Well, in a slow market, we're obviously going to have lots of overlapping bars. It's going to be the exact opposite. In a trending market, we had very little overlap. Here in a slow market, we've got lots of overlap. We're going to have smaller bars versus the trending market that had big bars. We're going to see big wicks and tails, a lot of indecision on these bars. And the bars will take a long time to print. This is an advantage that intraday traders have over end-of-day traders, is that you can actually watch the bars unfold. And a lot of times, you'll watch the bar and it will be laboring to go anywhere. Again, the exact opposite of what would be happening in a fast or a trending market. The fast trending market, the market's pushing, you see a lot of activity, the prices are moving back and forth rather quickly. In a slow or ranging market, sometimes I got to check, make sure my data feed is still on because the market is just not doing anything. Prices are going to wander, there's going to be very little follow through. What does that look like? Well, here you got a picture of a ranging market. So you can see there's the odd big bar in there, even an odd series of big bars. But again, there's very little follow through, a lot of candles with very long tails to them. A lot of smaller candles, especially as you get later into the session. A lot of sideways trading. So how do you trade a ranging market? How do you trade a slow-moving market? Well, the challenge in a slow-moving market is not where to get in. That's going to be the easy part because the bars tend to be smaller. Things aren't unfolding as quickly. The challenge will be picking the direction. Now, a lot of people think you can't make money in ranging markets. I find I actually, as a rule of thumb, tend to do better in a ranging market than in a trending market. And I think it's because everything is moving at a slower pace. When the market is trending and moving fast, you're pretty much just hitting that buy or sell market button and placing a stop as deep as you can afford and just hanging on for dear life, hoping the market doesn't make a sudden reversal against you. But in a slow-moving market, you have time. You have time to watch the market unfold, the bars unfold. You can plan your trade, but the challenge, as I said, is picking the market direction. To that end, you should remember the 75% rule. What's the 75% rule, you say? 3/4 of the time, the market will be in a sideways trading range. So if you're looking at a chart and you're not sure whether the market is trending or moving in a sideways trading range, chances are very good that the market is in a sideways trading range because 75% of the time, the market is in a trading range. So there's your default answer. If you're not sure, assume that you are in a trading range, unless the market shows you otherwise. When the market is in a trading range, or if you suspect that it's in a trading range, never trust a breakout. A good trading friend of mine used to drill this into my head. Never trust a breakout. Breakout trades look oh so tempting, and yet the vast majority of breakout trades fail. In fact, that's another part of the 75% rule, is that 75% of the time a breakout will fail. It's just another way of saying 75% of the time the market is in a sideways trading range. So if you suspect the market is in a sideways trading range, your job is to find the limits of the trading range, the upper and lower limits. And from there, you're going to buy low and you're going to sell high. So you're going to buy at the bottom end of the trading range. You're going to sell at the top end of the trading range. But you're not going to be greedy. You're going to go all in, all out, because the market's not going anywhere. It's a sideways trading range. You're going to take a scalp profit, maybe a small swing profit, but there is no point in swinging for the fences because chances are very good you're not going to get it. Unlike the trending or fast-moving market. If you suspect the market is trending or fast-moving, well then, of course, you're going to try to hang on a little bit longer. So here's that slow-moving market chart that we were looking at earlier, and you can see the little blue rectangle that I have there on the left side of the chart kind of highlighting the trading range. And then look at that big breakout bar to the upside. And what happens the very next bar? Yep, you got it. It reverses on itself and falls and breaks the bottom end of that earlier trading range. What happens after that, you ask? Well, you got it. It reverses on itself and goes and breaks the top end of the trading range, only to reverse on itself and try to head lower again. And you can see that every time it broke a significant swing low or swing high, the market tried to reverse and head the other direction. And it will continue to do so long as it is in a trading range. So market transitions. It's important to remember that when a market is in a trend, you need to watch, because that immediate trend is going to develop into a broader range. It's going to actually develop into a trading channel. And that trading channel will become broader again, and it will eventually become a trading range. Because all trends eventually turn into trading ranges. So if you're in a trending market, that's what your lookout is. You're in a trending market. The market will not trend indefinitely. You need to prepare yourself and look for signs that the market may be transitioning from a trend into a trading range. When a market is in a trading range, you're looking for a breakout move with momentum. Again, the exact opposite. When a market is in a trading range, you're going to look for that breakout. You're going to look for that retest. You're going to look for signs that the market is actually going to stay with the breakout. We've got some momentum here because all trends emerge from trading ranges. Right? It's that Wyckoff cycle that I showed you earlier. We went from trading range to trend to trading range to trend. And this cycle goes over and over and over again. And as I mentioned, it happens in all time frames also. So it doesn't matter whether you're trading intraday or end of day. It's something you need to be aware of. Don't ignore it. Some dates that can spark a trend. You might want to mark these on your calendar. FOMC minutes, of course. They're going to heavily influence the stock market, currencies, interest vehicles, crude oil and natural gas inventories, the weekly crude and natural gas inventory reports. If you're trading those particular commodities, you need to pay attention to those report dates, because if the market has been trading sideways Monday, Tuesday, Wednesday's crude inventory report might be the impetus to start a trend and break the market out of that 2-day sideways trading range. Remember, trends develop from trading ranges. So if you're in a trading range, be on the lookout for that trend. If you're trading the agriculturals, World Agricultural Supply and Demand Estimates is a guaranteed market mover, especially, midsummer, early midsummer. If you're trading corn, wheat, soybeans, these markets will be affected by the WASD report. And then, of course, there's always the non-farm payroll report, which is a biggie for the stock market and currencies to a lesser degree as well. Times to remember. The market's going to be fastest during the first hour of trading. So we're talking intraday now, of course. If you are trading intraday, it's that first hour of trading when you are most likely to see a trend develop. In fact, a lot of times in the trading room, when we're trading the DTS system, one of our signals is the first eagle signal. I know that means nothing to you, but that's one of our DTS tools. And it has a very high degree of success because it's looking for that early momentum that's coming out of the market, and it will pick it up, and very often it will develop into, if not a substantial trend, certainly enough of a trend that we can capitalize on it. You'll also want to take note of that first 15-minute mark into the session. A lot of times the market's going to give you a little bit of a head fake here. It's going to look like it's going one way and it's really going the other, so you may want to make a note of that. Also, pay attention to the end of opening range. Opening range, typically the first half hour of trading. A lot of times the market will make a reversal if there has been an opening range trend. If it doesn't reverse at the top of the hour, it's almost guaranteed to reverse an hour into trading or at the bottom of the next hour. But of course, this assumes that you have a trend preceding it. If there's no trend, you can't really count on a trend reversal. A couple personal observations. Most markets will make one major move per day. So if you've missed the move, you've missed the move. Don't bother trying to chase the market. You're not going to catch it. Just resign yourself to the fact that you dropped the ball, come back tomorrow. And I don't mean to sound condescending. There's a lot of times, well, I shouldn't say a lot, but there's a lot of times in the trading room where I will miss the major part of the move. Sometimes the market just leaves you flat-footed. Again, it's the nature of the markets to create confusion. So if you get in late or you don't get in at all, don't beat yourself up for it. But be aware that the big moves tend to occur within that first hour of trading. So if I'm going to take a chance on a trade, it's probably going to be in that first hour. And that's the time when I'm going to look for that momentum to come in. I'm going to look for the breakout. And if I think I can see it, then I'm going to extend my profit targets or leave a runner in play or do something to try to capitalize on that early momentum. Here is a little something that, again, a lot of traders don't consider, but it is oh so true. Very often, it's the worst looking trades that have the best follow through. And it's the best looking trades that have the worst follow through. It's almost as though the market knows how to tee it up to try to entice all these counter trend traders to get on board. When in fact the market's really not going to go counter trend, it's just going to continue with trend. So if you're looking at a trade and you got a little bit of a knot in your stomach and you're thinking, gee, it just doesn't look right, go for it, because that's probably the trade that's going to develop into the move of the trade, into the move of the day, and get you that big follow through that you've been looking for, if in fact it is going to be a trending kind of day. Markets also tend to reverse their overnight trend early in the session. That is, of course, if there is one. The overnight markets a lot more active now than they were even 10 years ago. There's a lot of activity in the Asian and European sessions, even in the NASDAQ and the S&P. So if you are starting your day and you see a dominant trend through the overnight, you can almost be guaranteed that the market will try to reverse that trend early in the day. That's what we saw happen today. The first 10, 15 minutes, the market tried to continue the overnight trend in the NASDAQ and the E-mini, and then it turned on its heels and did a full-on reversal. So something to bear in mind. Also, when it comes to trading, keep it simple. You know, I see so many traders come to me and their charts are just a mess. You know, it looks like they gave their little kid a box of crayons and said, here, go nuts, because there's lines every which way. Trading does not have to be difficult. It can be as difficult as you want it to be, of course, but normally simple is better. And what you want to do is you want to be able to make a decision off your chart. And believe it or not, whether the decision is right or wrong is secondary. Just the ability to make a decision is paramount. It's also important to remember that you can't make the market do anything. Your job as a trader is to take what the market is giving. In fact, I have a little sign in my office that says exactly that your job as a trader is to take what the market is giving. If the market's not giving, you're not taking. If the market is in a giving mood, well, then you can take more. But you got to get away from this production line mentality that plagues so many traders. Trading is not a production line. Now, there's very few absolutes in trading, but here are a few that you can take to the bank. First off, overtrading will kill you. Out of all the traders who have come to me for coaching over the years, easily 90% of them were overtraders. That was their problem. They were just looking for too many opportunities. You cannot continuously trade the market. I know there's all this glamour around HFT markets or HFT traders and how they micro scalp and they get in and out and stuff like that. Forget about it. You're not going to be able to do that. Not from your home computer. And yes, I know somebody's going to write me and tell me about so-and-so who's doing it from their home computer. But chances are very good that you're not going to make money trading that way. So refrain from over trading, and we're going to talk about that more in a little bit here. In trading, less is actually more. You can actually make more money trading less, and I'm going to show you how to do that in a moment. Once you've settled in and you've decided this is the market direction, this is the environment I'm in, this is how I'm going to trade, well, this allows you, then you find your trade, you take it, you capitalize correctly, and that's how you make money. As I said, you got to get away from that production line mentality. It plagues so many traders because your probabilities of finding a winning trade decrease as your trading frequency increases. In other words, it's much easier to find 2 winning trades a day than to try to find 20 winning trades. Think of it this way. A trade is essentially a 50-50 proposition. So it's not unlike flipping a coin. And I know some athletes out there are going to take exception to my example here, but just go with it because at the heart of it, this is how trading works. A trade will either win or it will lose. So just like a coin toss, it's a 50-50 proposition. What are the odds of flipping heads once? Well, it's 50%, right? What are the odds of flipping heads twice in a row? Well, your odds have been cut in half. Now it's down to 25%. Odds of flipping heads 3 times in a row. Well, it's cut in half again. Now you're down to 12.5%. And 4 times in a row, 6%. 5 times in a row, well, it's going to be about 3% of the time that you will be able to flip heads 5 times in a row. Trading is not unlike that. The odds of getting one winning trade essentially 50-50. The odds of getting 2 winning trades in a row, 25%. And your odds diminish as your frequency increases. So you actually do better trading less. So how do you stop over trading? Well, you can set a trade quota for yourself because the key is correct capitalization. Once you are able to trade consistently and you can perhaps take 2 or 3 trades a day and make $50 on each trade, well then your earnings increase by adding more contracts, not by trading more often. This is how the pros do it. They limit the number of trades and they try to finish with a positive result. So let's say, for example, that you're going to trade 3 times a day. And let's say your trades work out like this, where your first trade is a $300 loser, your second trade is a $100 winner, your third trade's a $100 winner. Okay, you've hit your 3 trade quota, but you still have a negative amount on the day. You're still down $100. Well, in this case, because we want to finish with a positive result, we're going to take trade number 4. And let's say trade number 4 is a $200 winner. So now you've made $100 profit. You've had your 3 trade quota and a positive result, so you stop trading. The way you increase your earnings now is not by trying to find trade number 5, trade number 6, trade number 7, but rather, as your account allows, you increase your exposure. You increase your contracts traded. So if you can do this on one contract and net $100 profit, then if you traded 2 contracts, well, that would be $200. If you traded 5 contracts, that would be $500. If you traded 10 contracts, that would be $1,000. And this isn't just me saying this. I endorse this fully in the trading room, and there are trading room members whose trading lives have been turned around by limiting the number of trades they take per day. And I'm not exaggerating when I say people will report to me at the end of the week and they'll say, hey, Eric, just this last week, one of our room members had a $3,100 week trading just 3 times per day. Only 3 trades per day. He says, that's my number 1 rule right now. I will not trade more than 3 times in a day. It works, folks. Don't overtrade. Because the secret is, once you can finish with a positive result, you increase your earnings with size. But I do need to caution you. You can't just keep trading indefinitely. You need to have a safety net, a maximum drawdown. Because every once in a while, the markets will just not cooperate with you. So you need a point where you say, I've had enough, I'm not trading anymore today. So to that end, like I said, you need a safety net, you need a spot where you say, that's it, I've had enough today, I'm not going to trade anymore. For me personally, it's 5% of my capital, but you can also have what I call an ouch number, a pain threshold. So it may be $1,000 for you, might be $500, maybe $5,000. You know, it depends on your personality, and it depends, of course, on how well you're funded. But take it from the pros. The pros focus on quality of trade over quantity of trades. The pros will sit there all day and wait for the right setup so that they can put their money on the line. Are you prepared to do that? Can you sit there for an hour or two, or maybe even 3, without taking a trade, just waiting for the right setup? The pros also know the odds of their trades. The pros know that, whatever their setup happens to be, that X% of the time the trade will work out this way. And you don't need to be trading a really, really high probability signal, because probabilities can be fudged. You can safely ignore all those emails that come into your inbox claiming the latest trading system that performs 93.75% of the time. I can guarantee you it does not. Probabilities can be skewed because what they do to skew the probabilities is they have very tight profit targets. So the pros know the odds of their trades. The pros trade less often but increase size in order to be successful. And honestly, folks, if it works for the pros, then it's something you should be doing too. Now, at the beginning here, we mentioned that we were going to also show you a tool that will help you identify the market environment so that you will know how to best trade the current market situation. That tool is the Trade Forecaster from Indicator Warehouse. The Trade Forecaster shows you what the current market environment is, and it will also forecast what the next market environment will be, so that you can prepare for it. So this is what the Trade Forecaster looks like. It sits up in the top corner of your chart, and right now, in this instance, it says that the market is in trend mode for about another 6 minutes, after which time it's going to scale down and move into swing mode. So how does the Trade Forecaster actually work? Well, it actually works very similar to how your weatherman forecasts the weather. And what a weather meteorologists do is they study weather patterns. They look at humidity, barometric pressure, wind speed, temperature, and so on, cloud formations, and they'll say, okay, the last time we had all these conditions, this is what the weather was. Well, the Trade Forecaster works in a similar fashion. It looks back in the history of your chart, and it says, oh, the last time these market conditions were present, this is what happened to price. And the Trade Forecaster does exactly that. Looks back in the history of the chart, correlates market conditions, and then will tell you what the current market condition is, and it will also forecast what the next one is likely to be. Well, why does that help you? Well, if the Trade Forecaster says that the market is in trend mode, you can probably anticipate better follow-through on your signals. You can probably anticipate smaller pullbacks on any counter trend move. So what does that move? Well, that means that you can probably afford to run a tighter stop, which may enable you to take another contract or two on the position without risking any more money. You can also have a further profit target, or maybe you'll try to scale out of a position. You'll try to run it a little bit further, try to capitalize on the fact that the market is in trend mode. What if the market's in scalp mode? Well, the exact opposite is to be expected. You're going to get less follow-through on your signals. So you're probably going to have bigger pullbacks. What does that mean? Well, you probably got to keep your stop a little deeper so that you don't get stopped out prematurely. You'll probably have to scale down your position size in order to afford that wider stop. You'll probably be better off going all in, all out on target. And as I already mentioned, you probably need a bigger stop to avoid a premature stop out. Swing mode is a transition period. It's in between the two. So as I mentioned earlier, if the market is in trend mode, you're going to anticipate that it's going to develop into a trend channel and finally into a trading range. Well, if it's in trend mode and moving into swing mode, then you're going to expect larger pullbacks to develop. You're going to lose some momentum as the market transitions from trending to swing to scalping. And vice versa. If it's moving from scalp mode into swing mode, well, then you can expect smaller pullbacks. You can expect momentum to increase as the market tries to develop a trend. So a trade forecaster, very, very helpful for helping you determine what the current market environment is, what the next market environment is likely to be. We have a promotion here for all you wonderful people who took the time to join us this afternoon. Adam, I'll let you explain the promo offer.
All right. Oh, that's interesting. So I've got, well, I guess we have two. I wasn't paying attention to our slides. I made two of them. So you can use the one on here, but for those of you that actually made it to the end of the presentation, I'll raise it up a little bit. You can also use the promo code, all caps, NT, like NinjaTrader, 10, and that'll work also. So either one of those. And the idea there is you can use that for any of the tools that we showed during this presentation, but you can do it for really anything in this shop. The only thing is I don't tend to keep these codes active for a long time, so I'm going to shut it down Monday night at midnight Eastern time. So in the meantime, though, if you have any questions about any of the products or services that Eric just discussed or anything else on our site, you're welcome to contact me. Here, let me give you my contact information. And this is Eric's. Okay. Any other questions while you've got us on the phone? I know Eric covered a lot of material.
And I know I went through it a little bit quickly, so don't hesitate to write us if I confused you somewhere along the way.
Well, and I was trying to answer questions furiously while the presentation was going on. So if I did my job correctly, we won't have any, and we'll stay accountable to time, and life is good. But of course, we'll stick around if need be. So great. Dave's asking how much. Each of the products are different. So go on over to the respective product pages, and if you scroll to the bottom, you'll see the different prices for the different tools. None of them are significantly expensive. I take that back. The Trade Manager is a significant investment because it's a complete money management and automated trailing stop module. But the other add-on tools are, more at the entry-level type position. Brian's asking if we have reversal markers. Brian, I'm not sure what you mean by that, but if you email me at adam@indicatorwarehouse.com, I'll give you a call and happy to discuss in more detail, see what exactly you're looking for. Rondre, I hope I pronounced your name correctly. I'm glad you like the material. Thank you. We try and keep this at an educational level and what I call edutainment.
Ooh, that's good. Did you
All
just
right.
make that up?
And I own the URL. How about that? And so, all right. I don't think we have anything else, so that means we did our jobs correctly. Thank you all for sticking around and being so interactive during the presentation. My fingers were moving fast, and it was a pleasure. And so it's always fun to talk to the NinjaTrader crowd. And I want to thank NinjaTrader for having us on. It's an honor to be part of the vendor ecosystem, and we will continue to do right by you. So with that, I'm going to hand it back over to Juanita.
Thank you, Adam. I want to again give a special thank you to Adam and Eric of Indicator Warehouse for joining us today and for a great presentation. NinjaTrader Ecosystem is pleased to sponsor these weekly vendor events as a value-added service for our clients. If you find value in these events, we hope you will attend them on a regular basis. We would like to remind you the information provided in this was that of Indicator Warehouse and not of NinjaTraders. All information was for educational purposes and should not be construed as trading advice. If you do find value in these events, we do hope that you join us for future events as well as for our platform training events. I did throw the link in the room to give you times and dates of platform training events. Again, we appreciate the time you spend with us. Enjoy the rest of your day, and we hope to see you in future webinars. Happy trading from all of us here at NinjaTrader. Thank you, everyone, and have a great day.